Right. Welcome, everybody, to another episode of Beyond Wall Street podcast. I am Nathan Bowers here with Brandon Nieves, per usual, and we're going to be discussing today a very important topic with anything to do financial, really, and that's compound interest, the light and the dark side of compounding interest. How it pertains to you, how you can utilize it for your advantages, and how to be aware of the disadvantages so that you can make the best decision possible. Always good to have you here, Brandon. Thank you for jumping on here and
Absolutely.
Find some of that really good insight you have on this topic. And let's I always say, let's start with the bad news first, because we end with the good and, happy ending, right? So we first, we talk about the bad of compound interest. The first thing we got here is disbursement of returns. Now, if you would just do me a favor and give us some elaboration on that. What does that mean?
So basically, the dispersion of the returns is basically when you're looking at a certain time period, like let's say 5 years. A 5-year window period, and you're accumulating money in that window period, and you have a certain return applied to that dispersion. So the dispersion is going to show us, it's the distribution of how those returns, how we're achieving them. Because like a person can experience a 10% return, right? And they can average a 10% return, but the average return is not what an investor actually gets. He gets an actual return. So you could actually get an average return of, let's say, 25%, but yet the dispersion of those returns can result in a negative return. And then to give you an example, let's say you start with $100,000, and if the market were to go up 50%, you got 150,000. Market goes down 50%, you got 75,000. If it goes up 50%, you got 112,500, and if it goes down 50%, you got 56,250. So in that time frame, the average was 25, but the actual was negative 47.43%. That was the negative return. So the compounding did not achieve the result that you wanted because you started with 100, but you ended up with 56. So when people think, oh, I'm getting a 25% return, they're thinking that 25% is applied to their account balance every single year, but it's not. It's how those returns are applied in those years. So if you get a return 1 year, and the next year you get, if the market goes up 10%, you start with 10 grand. Market goes up 10, you have now 11,000. The market goes up another 10, great. Now you got 12,000. Market goes down 20, now you're down, almost over $9,000. You're down. So now the dispersion means your negative, your compounding stopped and it went backwards. So now you ended up with less money. And so now you have to start from a lower point and then try to move forward again. So every time that happens, you lose time, and time is money. Time is money. So the three most important factors that I tell people that you really got to know, if anything, is you got to understand how compounding works, the good and the bad, and then also the time value of money. The time value simply means your money will never be worth more than it is right now.
Right.
Banks know that all too well. I mean, you think about it, they charge you interest on a credit card, let's say.
Everything.
Yeah, let's say the average credit card interest rate is what, 15%? So if you take the rule of 72, that means every 4 years they're doubling their money on you.
Yep. Just by loaning it out to you.
Exactly. Yeah. So compound interest, if it's not continuously growing uninterrupted, then you're not gaining compound interest. And stocks, people don't realize that stocks don't actually produce interest. Stocks produce dividends. The only time a compounding event occurs in a stock is when the dividends are reinvested. But a stock in of itself does not produce interest. And one of the things that compounding needs in order for it to function and grow is interest. But stocks can compound if their dividends are constantly reinvested. But because there's so much variance in stocks, the compounding always stops, goes, stops, and goes. So if you're trying to build wealth, you don't use the stock market to build wealth. You use the stock market to enhance your wealth. Therefore, keeping your compounding on this side of the equation, using the stock market as a place to just get higher returns and then applying it to your wealth building strategy.
Let me jump in real quick, because the big thing me and you try to do on this is talk about the cultural aspect of things we talk about. So we're talking about compounding interest, and you did something really cool when you brought up the bank. And I think a lot of people don't think about this, but people, you need a credit score to do a lot of things. But what is your credit score? It's the bank's trust in you. He's shown over 12 20 years that, or 10 years, that's a long time, 10 years would say that we can trust the fact that we'll get all of our money out of him over the line of credit. That's essentially what it is, because it's their faith in their ability to get their interest out of you over the duration of whatever your loan is. And that's essentially what it is. And that's your preferred credit rating. Cool. Yeah, we know we're going to get all the interest out of this guy and his mortgage or his car loan. So and you brought up in the last episode we did, how do you beat the bank? You become the bank. And we're talking about the cultural components of this. Is you really need to be aware of just how your money's being leveraged everywhere else besides in your own account. And that's the scary thing, is we gotta change that attitude back to people need to be independently taking care of these and making that compound interest work for them. And just one more side note, because my good buddy Mike was here visiting this week and we talked about this a little bit. He's got his plan going on in a Roth, and he's talking about, and we talked about this before too. It's funny how much we circle back to things, huh? He's saying, oh yeah, well, the market's going to go down over time. And people are so jaded to the fact, like, oh yeah, the market's it'll go down a little bit here and there. It'll bounce back up. I'm making a lot of money. It's like, and you're the one who said it too. You're on a 13-year bull run. It's hard not to make money. And so I asked him, I was like, okay, why are you okay with losing that money? Why wouldn't you invest in something that you don't have to worry about that, or not invest, but build wealth and have a separate line of wealth building where you're just achieving compounding interest the entire time? So it's a long conversation to have, but it's just about building the thought process with people. Hey, some things aren't all adding up. Hey, I never thought about it that way. Just getting those, those trains of thought in people's minds. So I didn't mean to go too off on there on you, Brandon, but
no, you're right. Your friend, look, a 13-year bull run, man. There's no accomplishment there as far as making returns. You just shouldn't brag about this. Is just, you made money. I made money in this duration of time, but I know that there's a peak. The market cycle goes in there's four aspects to it. So we had, after 2008, we had a recession. Well, a recession is the bottomed out. We bottomed out when you hit a recession. But what comes after that? An expansion. So they kept lowering the interest rates, right? It caused an artificial boom in the stock market. And that's all it was artificial. And so now we're coming down from that, from that high horse. And we're seeing high inflation. And so now interest rates are going to rise. They're literally purposely going to crash the market so that inflation can be adjusted. But now people are going to lose money. And people are all fearful about what the market. I have clients that call them, is everything on my accounts, are they going to be okay? And I always tell them, I said, well, remember some of the strategies that we implied? Remember when I talked about that index hedging? I says, yeah. I says, well, this is where this actually starts to shine in this type of an environment. So essentially what's happening is that when the market's going down like this, you're like, yeah, no problem. I get excited because I know the next big cycle, it's like this. So the market's down, you're loading up on cash, right? You're building up all this cash value. As an investor, that when the market, it's going to bottom out, but it's going to be another expansion again. And when then that happens, then you have all this cash, you're ready to jump in before the market takes its upturn. And now you can buy more stocks or just different opportunities at a discount value, you know? But you can only position yourself to do that if you have your money in a position where it's going to grow regardless of what market condition. If the market's up, great. Market's down, no problem. Your money is still compounding and growing. When your money is in a constant state of compounding and growing, whether in a bull market, bear market, sideways market, it doesn't matter. If your money is constantly compounding, I'm in a position to always get opportunities and not have to worry about, oh, if I got to sell this in order to get this, you got to sell this to get this, then you're just locking losses over here and applying them over there. You know, so you don't want to do that. You don't want to use investment money to make more investments in a down market. You got to use money that's not correlated to the market to make those investments in the market, if that makes sense, because that's how you juggle it around. And that's how the big boys do it. You always hear, oh, so-and-so is loading up on cash. They're loading up on cash. You know, what does that mean? They're loading up on cash. They're getting ready to strike an opportunity. But their money is out of the game right now. Their money's out of the game, but that's why they're loading up and they're ready to go in. They know something. That's a signal too. Why is so-and-so pulling out? They know something's up, and then that triggers all other investors, and all of a sudden they start pulling out. And then they see that, and they start pulling out, and then before you know it, boom, the market goes down.
Yeah, I think it's just wild to me to think, and I know because I was one of these people before I got into this industry. Is people have all that faith is I'll just go work a job, and the one plan I have is going to carry my sale all the way through the rest of my existence, my 401. And it's not because the 401k is bad, and it's great what they're doing because you get great accumulation, but you have to have the strategy in place too. And I see other people saying on Facebook, like, hey, anybody know any good stocks or cryptos to get in? It's like, well, truth be told, unless you have other assets like what we talked about with IULs, that you can compound an interest on the side to leverage your money to pull 10,000 out to throw into a crypto, you're not really ever gonna, unless you shoot the moon like with Dogecoin or whatever, and you put 5,000 in when it's less than a tenth of a cent, and it goes up to 65 cents. You're not going to make enough unless you have serious capital to invest in with that, and that's what a wide variety in your investment portfolio allows you to do, because you're not just in a singularity. You have multiple different cash flow options available to you. You have your 401k here, locked and loaded. It's an accumulation account. Great. Let that do its thing. But you also need to leverage your savings too. And if you're just putting that into your bank, the only person that's getting that compound interest is your bank, not you. But it's a good time to segue to the that next part, because you just highlighted it, the negative returns as far as bad when it comes to compounding interest. So let's really dig into that one here, Brandon.
Yeah. So when there's a negative return, like let's say you're starting out with $10,000, and you're averaging simple average of, let's say, 10%. Now, your average is always going to be that 10%, but let's say in a 3-year period, let's say the market goes up 30%. So now your 10,000 turns into 13,000. Let's say the market goes down 20%. So now your 13,000 drops to 10,400. Let's say the market goes up 20%. So now you're up, you're a little over $12,000, but the compounding was stopped. So you didn't get 10. You actually got 7. You actually got 7.66%. So had you not gotten any negative returns, you would have kept up with that 10. That 10 would have been you would have got 10, 10, and 10. But you didn't get that because you had one negative year. So you have stopped the compounding process. You've eliminated it.
And
so
you
now
see, you're teaching me stuff here, because I never thought, I'm newer, obviously, into the industry, and I never thought of it that way. That's it's not even a way of thinking about it. That's just the actuality of that's how it works. I just never thought of it that way. So I'm glad that you brought that up.
if you think about it, if you use the rule of 72, right? So you got the rule of 72. It's a great mathematical formula. It basically tells you, based on a certain interest rate, how many years it's going to take for your money to double. So if you got, 15 years, I was just had a client doing running a proposal, right? So she's got about 15 years before, she wants to retire. So I had to look at it and say, so, okay, how many compounding cycles does she have left? So I have to determine a rate of return. So in this environment, I'm going to probably, let's be a little bit moderate, conservative, with a little aggressiveness in there too. So I said, all right, what about if we do 7%? So if I do 7%, then I take that rule of 72 and then divide it by the 7. So I know I got 10 years to work with. So that means if she averages 7, her money is going to double every 10 years. Okay, but she's got 15. So what does that mean? That means I probably got to get a much higher return than 7. 7 is not going to cut it. The other option is, okay, she's got to put more money away if she doesn't want to take more risk. Okay, and if she can't do that either, then you're going to have to postpone your age that you want to retire. The fourth option is, or you're going to have to take a reduction in your lifestyle. Which is it going to be? Because in the end, our job is to manage the expectations that they have.
You know what is kind of the scary thing is some people be like, well, looks like I'll just work till I die then, instead of just, hey, just save $200 a month and you'll be fine. They're like, no.
Right, yeah.
Too much.
That's a sweet thought. Oh yeah, work until you die. That's sweet. That's sweet. But it's not practical.
No.
It's to work, to say I would work until I die is almost like, it's just wishful. To me, it's wishful thinking. You're gambling. You're just going to gamble that your health is going to be perfect. You're going to be Superman all the way down the road. Not to mention, your employer is going to keep you on board if you're working for somebody else.
Well, it depends. I hear construction workers say that. It's like, your body's not going to keep up for 50 more years. I promise. It's like, I have grandparents that did that. And, they were done at 60 pretty much. So.
Right. And then the other aspect too of this too is that you got to take all the other factors into play, because let's say you got a couple who's making $100,000 a year. You got a couple who's making $100,000 a year, and the average American family, when you add up all their expenses, liabilities, and bills, well, 34% goes to that. That's 34,000 is out the door. Then you got about another 55-60% going towards your lifestyle. And then the average Americans are putting away about maybe 5% of their income away, or let's say 6%. So if this couple, right, they're spending 34% on their bills and expenses, then another 55 to 60% towards their lifestyle, and then they're saying, I'm going to put away $6,000 a year, $500 a month. And then they average 12%. And they're ecstatic about that. They have no idea that that 12% is not doing nothing for them. And the reason is this, that 12% that they're getting on their $6,000 has to compete with all of the money that they're spending on their lifestyle and on their expenses and liabilities. How, if you got $100,000 and you're putting 10% of it away, that's $10,000. $10,000 has got to compete with $90,000 that you're spending. You know what kind of rate of return you got to get on your $10,000 every single year to compete with the $90,000 that you're throwing out every single year?
Are you referencing to get it to that income level when it comes to pull it out to maintain that income level?
Exactly. For that $10,000, they're going to have to get such a high rate of return to come, because the thing is, it's the time value of money. The compounding is working against you because your money is a depreciating asset. So your money is going down in value. So you got to fight that going upstream. Mm-hmm. And if that money is put in the wrong place at the wrong time, when you're ready, when you pull it out, when you need it the most, you're going to find out the truth about how compounding had worked in your favor. Because if it was all in a taxable environment, when you pull that money out, guess what?
Now it's competing with taxes too, not just your income.
And that's a state of compounding that doesn't stop. That compounding hits you year in, year out, year in, year out. So the idea behind it is, and I tell my clients, it seems complicated, but yet when you think about it, it's real simple, really. So you have these taxable category here, tax deferred category here, and a tax-free category here, right? And you got a series of different investments within those three categories. But that's all you got is three categories. See? So that's easy enough, right? I got three to work with. All right, great. So I established that. Then I established, okay, what's my time horizon? How many years am I going to give myself to have that money grow? Because it's all about wealth building is really about time.
Yep.
So you got to give that money cycles. And if you can get a consistency in a rate of return, that would actually do better for you than getting a home run here, and then you strike out there, another home run, another home run. Those are fine, those are good, but you use those at bats. When you get those home runs, you take those home runs hits and you apply them to your wealth building accounts. And those wealth building accounts, these are accounts too, Nathan, by the way, that commercial banks use, wealthy corporations use, Walt Disney has used,
the top 1%.
Rockefeller has used, Kennedy has used.
Pretty much every person of wealth that you look up to uses this.
Right.
A high percentage.
Right. And I said, why would anybody put money in those accounts? And then I looked into it and I said, oh, it's because of economics. It has nothing to do with the rate of return. It's about economics. It's because the business cycle goes through 4 cycles. So these types of accounts that we refer to, MPI, these accounts are based on not a micro, but a macro perspective. It's based on a wide range view of the economy. And that's what these accounts address, not the rate of return, because nobody controls that. It's about the overall personal economy that you live in. You're going to have an accumulation phase, you're going to have a distribution phase, and you're going to have a legacy phase, right? So you just got to, first of all, investments, you just don't invest money. It comes from a source. So you have to have cash, set up an emergency fund, number one, right? So you set that up, 6 to 8 months of expenses put aside, right? Then you establish a cash value. What's a cash value? Well, cash value is similar to your cash, but the difference is this money is earmarked for investment purposes, for opportunity purposes. It's your freedom fund. It's your emergency fund on steroids.
And to clarify too, just so everybody knows, it's just like a savings account. You have full access to it Monday through Friday, like your traditional IRAs, your Roth, or your 401k. You'll have a penalty if you try to access those. So it gives you the flexibility to actually leverage your money in a positive way on your behalf instead of other institutions doing it. But go ahead. I just want to
you're absolutely right. I mean, that's why all these banks, they apply these same strategies. If you think about it, they take your money, you put it into a savings account, and then they give you interest on that, right? But they're taking your same money and then they're putting it into these accounts, and they're getting 6% on that while they're paying you less than 1%. Look at all that. I mean, they're taking your money and turning it into something else for their economic benefit. It's not an evil thing. It's just,
no, it's how the world works.
Yeah. So you're just taking the same principles and you're just applying it to yourself. But you got to have, like I tell my clients, you got to have a central bank. The economy has a central bank. Every country has a central bank. You got to create your own central bank, not the bank that you bank at. That's not yours. That's theirs.
No, that's one of my favorite things you said on this podcast is the money in the bank. It's there for when you need it, but it's not actually there. It's somewhere. It's in someone's vehicle loan, someone's mortgage. It's out being leveraged.
Just a number on the ledger. It's just a number.
It's an IOU.
But that money's really not. It's an illusion. It's an illusion. And here's a big thing too, and this is really important that people got to understand this. What's happening now in the economy, we're having a situation because of the Dodd-Frank Act. If you got too much money in cash, because you got to establish cash first, right? But if you got too much money there, Oh, I don't like to take risk. I don't like to take risk. Well, now, guess what? Compounding is working against you, because if you're earning, let's just be nice and say you're earning 1%, right? So you take the rule of 72. Okay, well, now it's going to what? It's going to require you to wait 72 years for all your money to double in the bank.
Yep.
72 years. And then you put it in the stock market, but then we talked about the dark side of compounding with that. So people thinking, well, how the heck do I handle this? It's real simple. You got to have a midpoint. You got to have a midpoint that connects you to the stock market and that connects you to the banks. That's your midpoint. That is your central bank. It's the centralized personal economy that you have. Now, from that central bank, you transfer money from cash, then you transfer money to investment opportunities. Investment opportunities goes back into the cash value, then the cash value goes back into cash. I'm doing it all the time. I'm always transferring money from cash to cash value. I just got done paying off a loan on my cash value. I made a profit by just paying off my loan because my money was earning interest while I had that money outstanding. That money was, as I was borrowing it to myself, I paid it back. I was earning interest on it the whole time. People just got to start learning about these opportunities because they do exist.
I want to do a little bit on that real quick, Brandon. And if you're okay, we'll start hitting on the good a little bit just because we're getting towards our time goal here. When we bring up the aspect of becoming your own bank, if you're putting $1,000 a month into a savings account, once you build up that nest egg, Brandon was talking about that 6 to 8 months of cash flow. It's like Dave Ramsey's debt snowballing effect on steroids. And we actually use this in the life insurance business with debt-free life because the cash value that builds in these policies is so aggressive and it's safe. You will be slowly coming out of debt, even if you don't use it for, say, the retirement aspect, which is what it's geared for. You still have this compounding interest cash value building up. So you have student loans here, you got a car note here, you got this credit card debt, you have this whole life cash value earning policy. It gets to 2,000, you just nuke out a bill, and then it keeps going back up. You take 3,000 here, boom. Now you're slowly going out of debt, but instead of like the Dave Ramsey effect, you're just reconsolidating your bills. You're still building an asset here. You're just using it in a more intelligent way. And that's the thing. And we talk every time I talk to a new person about it, whether it's index universal life or dividend paying whole life, people say, I've never heard of this. Like, why aren't people doing this? Because you don't know about it, because you need to talk to a guy like me. And it took me 3 years in the insurance industry to know about these things too. So, that will bring us to our aspect. I'll go with the second one first, since we're on the topic. The good in compounding interest. There is a tax-free compounding interest.
Right, tax-free, yeah. And that's the key factor, because like I said earlier, when your money is compounding and then all of a sudden you take a negative turn, that's why I tell my clients, don't look at the stock market as a place to compound interest. That's not what the stock market's about. Stock market is about gaining opportunity through dividends, through ownership in companies, right? Now, when we're talking about compounding, you got another aspect, you got another layer to think about, is the taxes. Because every time a dollar compounds and you're in a 25% tax bracket, let's say, okay, so that dollar grew, let's say, to $2. But now you got to pay 25 cents on those $2. So now you flew backwards a little. So it's like taking 2 steps forward, 1 step back. If you keep doing 2 steps forward, 1 step back, you know what? You are going to move forward, but it's going to take you so much longer because you're constantly having to pay taxes on the interest that you're earning. So that messes with your compounding. So for every interest payment that you're getting, it's being deducted from you. And that percentage can be increased at any given moment. So tax-free compound interest helps your money grow exponentially.
Yep.
Because now, if you could protect your money from market deviations, then the next thing I got to worry about, okay, I did that, taxes. That can never go away. If the market goes down 25%, the market can go up 33 the next year and I can get back what I lost. But if I lose 25% towards taxes, I lose 25% towards taxes. I'll never see that money again. And that money is gone forever. And that money will never be, your money right now is the most it's ever going to worth is the value of it currently today. So if you can avoid taxes and market losses, and you can get a consistency in a competitive return, because here's the thing though too, Nathan, it's not a this idea of state of compounding, it doesn't end. You know when it ends? The state of compounding ends when you die, when you no longer exist. Because as long as you are alive, it doesn't matter, I don't care how old you are, even if you're in the distribution phase, even if you're just withdrawing income, while you're withdrawing income, your money is still got to be compounding. Because if it's not compounding anymore, then you're going to deplete your account and you're going to run out of cash.
Absolutely.
So the compounding is something that is supposed to start from the moment you start in the accumulation phase, and it goes all the way to the distribution phase, and then it ends at the legacy phase. And when it gets to the legacy phase, your money compounds one more time, and that's what you leave to your beneficiaries. And that also is tax-free. So tax-free in the accumulation, tax-free in the distribution, tax-free in the legacy. That's a state of uninterrupted compound interest. And all I tell my clients is this: you keep that as your midpoint, because now your money, you can switch money and pivot from one direction to another. If you need some more cash in your bank account, you can take it from your cash reserves, boom, put it in cash. If you need to make an investment opportunity, boom, you can take it from your cash reserves and make the investment opportunity. But your money in the cash reserve is growing uninterrupted, tax-free, with no market risk. That is a state of constant, uninterrupted compounding. And most people don't have that in their portfolio. And this is not a new idea or a new concept. This is something that's been around for as long as the taxes have been around, since 1913. Actually, these accounts have been around longer than that.
Yeah. And I just want to bring up something I was noting down as you were saying it. You talked about earlier how there's 4 key points in the economic circle, and how we talk about with these insurance opportunities, they cut the middle. They're designed to survive in all of those. But when you look at a typical IRA, and that's why we keep saying, like, folks, they're outdated. They weren't even meant to be doing that. If you have some
20th
extra
century
cash,
thinking.
yeah,
20th century planning.
It's because if you think about just the IRA as a whole, you really sit down, have a wholehearted discussion, and with yourself, if you have an IRA like that, it's the 4 major components. You're susceptible to taxes, ever changing. You're words are hard. You're subjected to fees. You're subjected to the change in the actual market itself, and you're subjected to market loss. Now, if you're trying to make the most out of your money, if you have an option that has 4 risk categories over here and 1 over here that has, 0 technically, what are you doing? Why are you not doing that? And we just so the whole thing is like, we want to get to you folks and talk to you about this on this podcast. Is you're not in the 21st century way of leveraging your money, because we can change just the framework of the everyday household just by teaching folks, like, if you invest in these accounts, I wouldn't say invest, if you build wealth inside these accounts, sheltered, you're getting uninterrupted compound interest, which is amazing to me, Brand, that Dave Ramsey isn't all over this, because he's Mr. Compound Interest. But if there's no interruption in compound interest over here, and the whole everything that he promotes on the other side of things has interruptible compound interest, doesn't make a lot of sense, does it? But that's our whole goal here, is just to spread the word and raise the awareness that, hey, there's a new kid on the block, and he's here to stay.
And the wealthiest sector in our nation's economy has been exploiting it for decades, and it's about time that everybody else finds out about it.
Yep. Let's just go over, because we'll just do this for our closing points here, just because we're getting to our time. I want to just run by you, Brandon. Think about when someone hits 18 years old, they get their first job. They know, instead of, I got to get my 401k going, I got to get my index universal life policy spooled up, $200 a month. By the time I'm 25, what am I doing? I got a couple, couple tens of thousand in there, probably 10 to 20,000. That's there. And I also been building up my savings account. So now I'm a young man, 25 years old. I got 5,000 in my savings account. I got 20,000 in leverageable cash in my index universal life. That's going to keep growing. I just got my big job. Boom. Now I can bump up, $400 a month over here and get more compounding and build my savings more. Hey, you know what? I like this crypto thing. I'm gonna pull 10 grand out and throw it into crypto because now I can actually, I don't know, earn those dividends on the amount of, stocks or the crypto I hold to make an actual sizable difference in your financial, statement when you go to pull it out versus, I'll throw $100 into crypto. It's not going to do anything. But now because you invested in, or relocated your funds into, sorry, I'm going terminology here with it. Building wealth in a tax-free account is giving you power to leverage your cash and all those assets that you want to be in, but you just don't have the proper amount of cash flow to get the returns that you want. Because the stock market's not going to make you a millionaire unless you can put in a decent amount of cash to do it.
Right.
You got to have an investment to get a return, right?
That's right. That's right.
So,
that's right. It's it's about the whole thing called capital. Capital is the resource that all production is made out of. When they make a movie, when a movie is created, they're not using investments, they're using capital. Capital is what makes investments work.
Yep.
It's not coming from investments are not coming from investment. No, it's capital that jumpstarts investment opportunities. So the thing that I started to understand in my journey as a practitioner in this industry, but also in my own personal life, I started figuring out that the biggest problem was financing.
Yeah.
That's the missing link. When I read about it, I was like, oh my God. I wasn't even excited about telling other people. I didn't care about telling other people. I was like excited for myself and my family. I was like, oh wow, because you're putting money away, you're putting money away, and then one day you need money. Oh, can't touch it from here. Oh, can't touch it from over there. Don't want to touch it from over here because then I screw that whole thing up. I got to touch it from my cash, but that's for an emergency. So if an investment opportunity comes up, you can't pounce. Mm-hmm. Because you can, but you got to use your cash. So either way, you have to take a personal loss, in some direction, to get some personal gain. Well, what if you could get rid of being in that position? What if you could jump on an opportunity and utilize your own resources of financial accounts, but not be in a position to deplete anything? That way, if I make that investment in crypto, and crypto goes south, I didn't lose any money. Why? Because I didn't use my own money. I collateralized it. Collateralization. If you widen your collateral capacity, that just positions you to earn more interest on your own assets. That's what collateral capacity means. You're just earning more interest on your spending. Because you're collateralizing your assets, you're not depleting them. You're not taking money from them, you're borrowing against them. But you got to do it in a way that you're in control. Because you could do it with a bank, you can. The problem with that is, okay, you got your accounts at bay, but the problem is that you got to pay them back on their terms. So you got to be the bank. And there are ways to be the bank. These insurance contracts, they give you ownership rights as a bilateral agreement, which means one party takes on all the risk, not you. If it was, do I say bilateral? No, unilateral. I'm sorry. Bilateral is when two parties take on risk. Unilateral is when one party takes on the risk. So a unilateral agreement that gives you ownership rights that completely separates you from the tax code. You are no longer under the radar when it comes to taxation. So you can avoid it. And this is perfectly legal. It's perfectly legal because it does a social good for society. That's why the IRS honors it. But the reason why you folks haven't heard about it is because it's by design. The government mandated back in the mid-1980s that these companies cannot advertise these types of products to the general public. The only way you're ever going to find out about it is through some type of investment or advisory forum, like Nathan and I, if you spoke with us. That's the only way you're going to find out about it. And one guy
Because
said,
they don't want people in them because they lose their tax revenues.
Yeah, exactly. And you know,
but the banks want them.
I really don't want, I thought about this. I don't want everybody doing this either. Because you think about it, if every American starts applying the strategies that we're talking about, it could lose its tax advantages. I don't know. But it's actually a good thing that not everybody knows about it. But for those that pay attention, look, it's the 21st century, man. I mean, it's not about putting money in your, maximize your 401k, IRA contributions, defer taxes into the future, and use the stock market all along the way. That doesn't work anymore. That worked maybe when you had a pension and when you had Social Security was more guaranteed, that you knew that what you were going to get is what you were going to get. Now there's no pension. Social Security is up for grabs. We got issues with Medicare. The market is more volatile than it's ever been before because we live in a globalized economy. Information travels so fast. You need new strategies, new ideas. Well, there's something. If you know the benefits of offshore banks, well, think about it. You want to be your own banker, but have the same benefits as an offshore bank.
Just the amount of hardship. Like you wouldn't even I do this all the time. I love running children's IUL policy illustrations because $100 a month from the day they're born, everything's paid for their entire life. Just it could be from this account. Their college tuition available, 10 grand, 20 grand if they need it. Good, because at that age, there's over $30,000 in there. Their first home at age 30 to 35, there's well over $100,000 in there, well over it. And then you're talking about age 60, over $1 million in an IUL, or close to $1 million in IUL, which pays out in comparison. I show $1 million in a 401k, and an IUL with not even half of that in it at the same time will pay out almost 2 to 3 times in the cash value on the distribution phase. And everything's all the major financial cataclysms you run into are your first car, your college tuition if they want to. If they don't want to go to college, they already have a down payment for a house, or they can pay for a whole house if if they wanted to, depending on how much cash flow they want to take out of it. But they also have the retirement there. You can beef it up when they're 20, 23 years old and they take over the policy. They get it's all figured out. And it's just like, hello.
Right.
Like everything
it's not a product. It's not a product. It's an economic tool. It's based on a wealth building strategy. That's why you said it earlier. You corrected yourself too. It's not an investment.
No,
because we got plenty of those already. We don't have an investment problem. What we have is a capitalization problem. That's all we got. And capitalization is about capitalizing on all opportunities in life. And you don't know what those opportunities are going to be. So you got to be in a position to act instead of react. Building wealth is not about how much money you make. It's about being in a position to protect yourself from an ultimate financial loss, or be in a position to gain from an investment opportunity. That's wealth. We're not talking about making lots of money, being rich. That's just making a lot of money. That's high income. But what we're talking about, wealth building, is about constant state of flux, where your money is growing for you. Because here's the thing, you got to build up passive income. You have to build that up. Mm-hmm. So I already know what my investment strategy. I think I got it all figured. It's done. It's perfect for me. May not be the right strategy for everybody, but I'll tell you, for me, it's all about being liquid. It's all about not having to pay taxes. It's all about protecting my principal at all costs, because that way my money is constantly compounding. When I got that, I got a permission slip now to take more risk. Now I can invest in crypto. And if I take a loss, it's not a big deal because my money is still growing over here. But you see, that's the whole thing. Your money has just got to be separate from the way that things are today.
All right. We're getting to that time, Brandon. Final thoughts, if those weren't your final thoughts.
No, that was it. That was my final thoughts. Compound interest, and for it to work for you, just understand the risks. Like Nathan said, market risk, tax risk, inflationary risk, and longevity risk. If your money can be compounding in all 4 of those areas, if you could figure out a way to do that, which we have figured out, there's ways of doing it. It's not a secret. Okay. If you could do that, that's the foundation. And then from the foundation, then you can start adding the window treatments and the roof and decorating the house. But a beautiful house has to start with a solid foundation. And that is what these contracts are all about.
Absolutely. Here's my final thoughts. Things constantly change. Everything is in constant change and a rate of change. The new way to do things is here. There's a new way to build wealth. The possibilities exist, and we're highlighting them for everybody out there to take advantage of these, because everybody's lives can be catastrophically different just because utilizing these tools that are available. Hey, child's born, whatever you can do, index universal life policy, open it from day one. By the time they're even 18, they don't even know this silent compounding snowball, this monster is already ready for them and available. Just getting that attitude. If you're going to retire, this is just my opinion. This is an opinion podcast. If you're going to retire, you're putting all your eggs in one basket, don't do the 401k. There's nothing that I meet with that I can tell you out of meeting with everybody. Go ask someone who's retired right now what they wish they would have done. And they hear, and you tell them about, hey, you're thinking about this. I wish I would have done that. I wish I would have planned more. Well, the better way to do it is here. And the better way to financially go about your life is here, because when you can start becoming your own financial institution instead of relying on all the other financial institutions, you are doing the best job you can. Now I can buy a car cash whenever I want, because my parents set this up for me when I was an infant, and now there's $120,000 in there. I don't have to worry about if I'm gonna have down payment for a house, because I'll have $50,000 whenever I buy a house. My retirement, it was started when I was an infant. Don't have to worry about it. Hey, I'm looking to start leveraging my own cash. Great. Constant, year by year, compound interest tax. Well, man, without caffeine today, my brain is just pudding. But constant compounding, tax-free, market sheltered, indexed returns added to it. You're doing the most possible for your dollar. Why wouldn't you want to do that? So that's just my 2 cents. It's here. You can be fearful all you want. You're just gonna miss out on it, and you're gonna wish it. So
awesome.
All right. How do you think we did? I think that was probably about 25 minutes. It felt like 25 minutes.
It felt like it. It always feels like 25 minutes.
Yeah. And then we get out and it's like, oh, 37. Oh, well.
Yeah. Like, oh yeah, we did an hour? That felt like 10, Wow. It flies by for us.
Well, anyway, guys, thanks for tuning in. I know we broke our Twitch record, Brandon. We had 4 viewers at one time, so we're getting there.
Oh, yeah, we're building traction. There you go.
Yeah, that's right. Well, thank you for everybody for tuning in this episode, whether it's on YouTube or Twitch. If you see us on Twitch, give us a subscribe if you don't mind. Helps us out, grow popularity, get our feet off the ground here, and getting out there, reaching more people. If you see us on YouTube, anything to adjourn the algorithm. If you just want to comment, say nice video, or tell us what you didn't like about it, we're not going to get too swirled up about it. Likes and follows on YouTube are greatly appreciated. Share it on Facebook if you like what you hear. This has been the Beyond Wall Street podcast with your host Nathan Bowers and the one and only Brandon Nieves. Thank you for tuning in, everybody.
Awesome. Thank you, everyone. All right.